I was running $1 million today, or $10 million for that matter, I'd be fully invested. Anyone who says that size does not hurt investment performance is selling. The highest rates of return I've achieved were in the 1950s. I killed the Dow. You ought to see the numbers. But I was investing peanuts then. It's a huge structural advantage not to have a lot of money. I think I could make you a 50% return on $1 million. No, I know I could. I guarantee that. This is what Buffett stated in a 1999 Business Week interview. Warren Buffett is currently in charge of hundreds of billions of dollars in investments. Buffett oversees a sizable portion of Berkshire Hathaway's $516 billion in assets, which include his investment firm. Warren Buffett, on the other hand, would be a very different story if he had to handle just $1 million. Even more astoundingly, Buffett would be able to achieve a 50% return on that $1 million. It is our goal in this video to explain how Warren Buffett was able to get such a high rate of return on his investments. If you're new to our channel, please subscribe to see more videos like this. Let's get started. Strategy 1. It is necessary for Warren Buffett to look at really large stocks because of his enormous wealth. Buffett would be wasting his money if he invested $1 million in a startup. It doesn't matter how much money he makes on this compared to the billions of dollars that Warren Buffett manages. However, if Buffett had only $1 million to invest, he might still make a significant impact on his whole portfolio by investing in smaller companies. If he made $500,000, it would have a 50% impact on his entire portfolio, making it worthwhile. What Warren Buffett said when questioned about how he would attain these big returns is what I'd like to show you now. Buffett stated, "There are tiny little areas," as I said in that Adam Smith interview a few years ago, where if you start with A and you go through and look at everything, and look for small securities in your area of competence where you can understand the business and occasionally find little arbitrage situations or little wrinkles here and there in the market. I think working with a very small sum, there is an opportunity to earn very higher returns. This means that you begin by picking an area of interest, such as artificial intelligence or the semiconductor sector or the gaming industry or the blockchain industry. Whatever it is, you begin there. It doesn't matter what industry you choose, you must become an expert in that field. Finally, take a look at small cap stocks in their field. All of these shares have their flaws, hidden gems, and arbitrage opportunities that can make you a lot of money. But the key is to focus on an industry that you have some familiarity with and an interest in. The best bargains can be found by researching all of the smaller companies in the field. Strategy 2. There are a number of strategies you can employ when searching at smaller companies with American stock or American companies. Warren Buffett has a special place in his heart for American equities because they are the ones that made him wealthy. For decades, the United States has been known for its integrity and business-minded approach to life. For small firms, it's important that you can rely on their data, and this is essentially true for organizations in the United States. The U.S. stock market is extensively monitored by the Securities and Exchange Commission and other authorities to ensure that each company's reported figures are accurate. There are exceptions to this rule if you're looking to invest in tiny businesses in nations like China or the developing world. The stock market's numbers are shaky at best, and that's simply the way it is. In China or other third world countries, American citizens or certain Westerners will tell you exactly the same thing. Business practices and regulations are not the same in the United States. When looking at smaller enterprises in foreign nations, it's difficult to determine whether or not to believe the numbers you're seeing. As a result, those countries pose an unacceptably high level of danger. Various countries such as Canada, Australia, and the United Kingdom are exceptions. Analyzing smaller cap stocks in those countries, in our opinion, is perfectly acceptable. Also, their commercial operations are thoroughly regulated. But still, the United States, according to Buffett, is the best place to do it. Strategy 3. Stocks should only be purchased at a discount to their intrinsic value. The advantage of looking at small cap stocks is that they are always frequently underanalyzed. There are numerous on the market that are selling for far less than their true worth. Because huge names like Netflix, Amazon, and Microsoft are scrutinized by so many analysts, they don't always offer the same prospects as others that haven't been scrutinized as extensively. So if you're looking at small cap stocks, make sure you understand how to assess their worth, and everything will fall into place. Only purchase them when the price is well below their intrinsic value. This is the only way to secure extremely big profits. Whether the stock is overpriced or underpriced, your goal is to purchase it. The lower the stock's price, the more likely it is to earn a large return on your investment. As an example, if a stock earns $1 per year and you spend $10 for it, you'll get a 10% return on your initial investment. As another example, let's say you spend $2 per share for the stock. That means you're getting 50% return on your investments. It's fairly simple math. Strategy 4. Emotions play a big role in the investing process. This is a common occurrence. Just look at the stock price of Tesla, for example. Investors in this company are the happiest in the world and believe they will become wealthy soon. In the blink of an eye, they're all running for their lives since quarterly earnings are down. You'll make a lot of money if you can step back and look at the facts, and you'll discover that the best possibilities to generate money arise precisely because everyone else is afraid. When everyone is running for the hills, that's when you want to buy a stock. Take a look at the performance of Facebook stock over the first half of 2018. In the wake of previous scandals like Cambridge, investors got concerned about privacy concerns and the price fell like a stone. This was the perfect time to invest in Facebook stock since the stats were so amazing at the time and everyone was frightened and fearful. This is when I bought a lot of Facebook stock. The foundation was solid. According to the data, the company's earnings were still on the rise. The number of users was increasing and the company was continuing to expand. So I acquired a lot of Facebook shares when it was less expensive in order to diversify my portfolio. A stock market crash could happen soon, in the medium term or in the future, which is why this is such an important factor in getting high investing returns. To make money like those who bought in 2009, you must be able to keep your emotions under control and buy stocks when they are falling. Strategy 5. If you're going to invest, you're going to be one of those people that spend a lot of time flipping through the pages and analyzing stocks. As a great investor Peter Lynch have said in the past, I've always said that if you look at 10 companies, you find one company that's interesting. If you look at 20 companies, then you may find 2. If you look at 100, you may find 10. The person that turns over the most rocks wins the game. If you look through a lot of stocks, read a lot of shareholder reports, and watch a lot of YouTube videos, your investment returns will be better. That's all for today. What are your thoughts on Warren Buffett's explanation? Join the conversation in the comment section below. Please click the like and subscribe buttons if you enjoy the video. We'll see you in the next video.